with the PAYG 1515 tax variation form, what you do is you pre-lodge your tax return for the year ahead based on the calculated and accurate income and expense, and including deductions, so depreciation from that property asset, that allows you through an accountant, and the accountants do this all the time. It's a very simple process. It's like a smaller version of a tax return, so it's often a well-priced type of transactions for an accountant that won't cost too much, and certainly the benefit of getting the tax savings back in your pocket more regularly, back in your paycheck, taking those tax savings back in your pay. How? Because this tax variation form, when submitted, gets lodged to the ATO, and they send a letter to your payroll saying, please reduce Mr. and Mrs. example, taxable income, and not the one per person, of course, from, say, 30% or 28% down to 19%. And that will mean that the difference that it's come down by now sits with you. It stays with you. It's extra money in your pay. And back to putting more cash flow more regularly through your home loan, that tax savings then goes through your home loan in your pay and should sit there. And should certainly sit there for as long as possible. But it's an inflow. When I say as long as possible, it's going to be received when you receive your pay. And obviously from that, we have some expenses that are related to the property and related to your day-to-day. So we're putting more cash flow more regularly, and we want to be able to see the income that goes in total versus the expense that comes out, is allowing you to build your offset account over time, or at least make sure you're not going backwards. That wouldn't be the case. We'd help you manage it, and you'd be able to prudently manage it anyway, because we're not talking about transactions going to put you in that situation. We're talking about something that's there to help. But certainly having your offset at least stay static whilst you chip away and pay off your home loan by making principal interest repayments. Ideally, you want to see less interest being charged on your home loan, and therefore those savings that you generate, small and growing over time, allow you to get extra principal paid off your home loan, allowing you then, with other factors such as interest rate management, rising rents, to be able to put more cash flow through your offset account, and therefore saving more interest, and therefore being able to grow your offset to the point where you can actually make extra payments and have more accelerated debt reduction. So that accelerated debt reduction allows you to pay off your home loan more quickly. And we'll go through our investment analysis reports and our business case reports that show on the specific calculations what that cash flow, month in, month out, for the period of your plan, with the total of your income, so your net income, the rent and the tax savings, less your living expenses, less the interest on your home loan, less, obviously, the payment and interest cost to your B account, I'll get that in just a sec, less the expenses such as property management fees which come out of the rent anyway, rates and insurances, anything that's attached to holding that property asset, so property holding costs, and then less the interest on your investment loan or the payment on your investment loan, you'll still see over a period of time that you will pay off your home loan more quickly than you do at the moment. And that's the first objective, to reduce your home loan debt more quickly. So with that being identified, I touched on the B account. So we want to pay off your home loan account, your A account, your non-tax deductible personal home loan debt as quickly as possible. So we've identified how that works. Now, we've got your B account, and that B account has a limit of $130,000, and that B account, we use say about $120,000 of that to assist you acquire and integrate that property asset into your circumstance. Because we know we've got a $400,000 loan against the property, but we have to get the deposit from somewhere. And you've used your home and actually got it starting to work for you. You know, turn your home from, well, a home that is a last tax-free asset. Owner-occupied homes don't pay tax. But you're going to use that equity really effectively now to help you grow your asset pool and get it working for you. Because it's now giving you an extra, or another asset, as well as income in the form of rent and tax savings. So that B account is accessing some of the equity, not all of it, and you've only had to use 130K of that to integrate that asset. And the rest of the debt, which is good debt, is attached to the investment loan. So the B account and the investment loan attached to the investment property are good debt. Well, why? Because it's tax deductible debt, as compared to the bad debt, which is your home loan, which is non-tax deductible debt. So back to that circle where you earn the income and you pay the tax, then you pay the mortgage or you pay your loan payment. The difference in this situation is you get some tax savings on top. So you earn the money, you pay the tax, you pay the interest on the loan, and then you get some tax savings back because of that. So it actually reduces the real interest rate, the real cost of that debt. And let's just look at that for a moment. If you earn money and you pay tax and you pay it towards a home loan that's non-tax deductible, your home loan rate might be 3%, but the portion of money that went towards that home loan payment had tax on it, maybe 1.5 or 2%, let's call it 2%, or 20% of your income, or 20% tax rate, that equates to, say, a 5% real cost of funds. So that portion, for you to pay that mortgage, you have to earn the money to pay the tax, just say 2%, plus pay the interest on the loan, which means the cost of funds may be closer to 5%. It's paid in after-tax dollars. Whereas that's bad debt. In good debt, you've got a situation where you earn the money, you pay the tax, you pay the interest, but then you get some of that tax back because of the interest cost. So it's reduced your real cost of those funds, reducing the rate that you're actually paying. So the real interest rate comes down. So it's good debt. So we want more of good debt, less of bad debt. Smash the bad debt, get rid of that. And obviously once that home loan's gone, then we start paying off the next most expensive, which is the bad debt, which is the good debt. Sorry about that. So once we clear the home loan, then we start to pay off the next most expensive debt, which is your investment debt, the good debt, because it's the only debt you'll have. We focus on reducing the B account, paying that off, and then from there, it goes towards paying down and accelerated rate your investment loan. So just let's take a snapshot now. We've now got a situation where you've got a home with an A account, which is your home loan. You've got a B account, which is your deposit and cost facility, the first of your good debt facilities. And we've drawn a line in the sand. We step over that. And on the other side of that line, in your situation now, you own an investment vehicle in the form of a direct residential property, and that's got an investment debt against it as well. Sorry, investment loan against it, which is also good debt. We want to pay off the home loan by putting as much cash flow as regularly as possible through and against that home loan. Now, my question to you is, what would you do once your home loan's paid off? Well, what you do is you direct that home loan payment, the equivalent, towards the next most expensive debt, the good debt, the first good debt, the B account. And we'd start to smash that. But imagine it's your mortgage payment plus the rent plus the tax savings now doing that. What do you think would happen to that debt? It'd be paid back really quickly. Or as compared in relative terms to the normal term of that loan, you pay back really quickly. And then once that's gone, well, what would you do then? Well, you'd start to smash the investment loan debt. But once you start paying back the B account and the investment loan, you're starting to build equity from day one. You're not just relying on open market forces. You don't have to rely on the property value increasing over time for you to achieve increase in your net worth, increase in equity. Now, what if we could do that from day one? And that's what we do. We put as much cash flow, all your income, all your tax savings, all the rent into your offset account. We then, from there, pay your living expenses, pay the principal and interest home loan payment on your A account, the bad debt. We then pay a principal and interest payment to your B account. We then pay a principal and interest payment to your investment loan attached to the investment property at a completely different lender or the same lender, but certainly standalone, completely standalone. So your home's only got A and B against it, and your investment's got C account and the investment loan against it, solely. Now, with that, what you're doing is it's called forced savings. You're building up equity by paying down the principal on those loans. from day one. So in 2 years' time, you've got equity acquired or built up, and what do you reckon you could do with that equity? Based on the situation where you've reduced your home loan debt, you've built up some equity or some further equity in your home because you've also paid down a portion of your B account, and you've also paid down a portion of the C account, giving you some equity in the existing, or giving you some equity in the first investment, now your existing investment property. What could you perhaps do then? And what it is you've got to monitor and have a view that this is a simple plan. It can sit in the background and work as long as you're just across your inflows and outflows. And then monitoring its values and doing the reviews with us on a regular basis. And the best part about our structure is that we are the rental property managers. So we'll manage that asset. So we're in contact with you weekly about what's happening with that asset. We stand by the investment vehicles. We help our clients integrate into their situation. And we get them tenanted and we manage it thereafter. And our management fees are lower than what you'd pay in the open market, where you might pay some 8.75% all up, 7.5%, 8% plus GST. Our fees are from about 6.5% plus GST. So with that, let's call it 6.75%, we're about 25% cheaper than the market. So your expenses are lower. We pay rent weekly because we want more cash flow more regularly through our clients' debt facilities to help them reduce their interest costs, pay off their debts more quickly, and get the maximum return on investment from that investment vehicle. So with that, we've got a situation where we're paying down those debts, and you've got that equity built up across your lifestyle asset, your home, and your first investment asset. What can you do? Well, the first step of acquiring an investment vehicle and integrating that into your situation, that's the first step. It's giving you a foundation. What you could also do, what we could do at that point in time, is do something else, do it again. Replicate that structure, as long as it's creditworthy and affordable, and we'll stress test it through the way to make sure it is. But adding another asset where it gives you additional rental income, additional tax savings, and now an opportunity to grow your asset pool again, that's where you start to really get a compounding effect. And you've now got some real growth asset, a quantum of growth assets that could be about the $1 million value range, accessing those open market sources, whilst you're still paying down debt. And the integrity of the structure stays the same. We keep it the same. We keep principal interest payments occurring to pay down the debt. So you're building equity along the way. Now, with that, there's some very important fundamentals and criteria that any investment vehicle that we integrate into your situation must satisfy. We're not going to go through that today. It's involved. We're going to do that in a separate show to make sure we get that right. It's really important. It's not easy. It's not as simple as just going out and going, yeah, look at that. That's a property. Looks like it works. Let's plug it in. No. We're talking about a business case here. And currently we're talking about the numbers. And property is simply a vehicle. It's there to do a job. It's there to give you an income, tax saving, and growth over the medium to long term. It's a long-term asset. It's an index asset, a traditional index asset. Plug it in and let it do its thing over time. But as long as it meets the fundamentals and criteria to start with, and through that, what we do is we identify what the business case needs are, what the range and price point and the affordability and creditworthiness sits at. Knowing those fundamentals and criteria, it would then be the mandate of, would give a mandate to our Elk Realty, our licensed real estate and property specialised division, to go and find the assets in the marketplace, in the open market, because we're completely independent. They do the job you need to plug in and satisfy the requirements of that business case, as well as obviously, before they even are considered, before they even are even shortlisted, tick all the boxes in our fundamentals and criteria. So we're going to do that as a separate show, and we'll do that next. Radio show number 2 or number 3 in this series. Now, we've identified that we plug an asset in, being a first investment vehicle. That's what we'll talk about at this stage. We've got the ability to, in the future, to continue to grow your assets in the same way, just duplicating it each time, to build you a portfolio that does a job of low-cost core holdings, large, low-cost core holdings. such as direct residential property assets. Why is that important? Because we're doing this as part of a strategy. And so far, if you recall, we're looking at your overall financial world, but we've really only spoken about your personal financial world, part 1.1. Not, if you remember, we drew a firm firewall. We drew a big line and a big firewall. We step over that to your super world. We haven't talked about your super world yet, part 1.1a. Now, that's important because as part of your overall strategy, what we're building is a barbell portfolio. That barbell portfolio is very important because at each end of the bar, we've got two very distinctive types of assets that are there to do a job for you and achieve for you what you need over time. How does that work? What's that look like? Well, imagine, and unfortunately the Olympics have been cancelled this year, but imagine you're watching the Olympics and you've got this world record holder, Turkish weightlifter, really muscly guy with short arms, and he's about to get that weight lifted over his head. And when you look at that weight, in this instance, we've got a weight in front of him, or you're seeing that full barbell with weights on the left and weights on the right, and a bar that holds it all together. On the left-hand side of the barbell are the biggest weights on the bar. Let's call them the 200 kilogram weights, so 200 kgs. And at the moment, in what we're talking about, we've got one 200 kg or 200 kg weight on the left-hand side of the bar. And then on the other side of the bar, we've got a number of other weights. At the moment, we've got about 220k of weights currently held in the super world, in the super environment. And that's invested in the usual suspects, such as Australian shares, international shares, fixed interest, listed property, and some cash. Because that's typically what most balanced funds, and most people have a balance to growth type fund structure. That's what they look like. What we want to do is go, well, how are they currently sliced up, and how can we perhaps slice it up to allow you to do what you need to and have the funds you need for your retirement? Because we've already projected that out. We've said, okay, well, that 220k now, based on your contributions, based on the growth of that investment at the time, is still going to give you a shortfall. Well, the definition of madness is doing the same thing over and over and expecting a different result. And that money's got to work its ass off, because 220k can only do so much. So how can you grow your asset pool to have more money invested? Well, in your personal world, I've already identified the strategy that fits for you. Property-focused investor that is most comfortable with that asset in all respects. That's how it often starts anyway. Where they've identified that's an asset, because everyone owns a home, or nearly everyone owns a home. And this strategy, it's a simple plan. There's nothing difficult to it. But to get it right and done right, there's a lot of peculiar considerations that need to be made sure are done right to get it spot on, to allow you to do what it needs to. That's the simple plan, the part 1.1. It starts to become still a simple plan, but where the intellectual property expertise becomes far more significant is when we start to look at your overall barbell portfolio. And that's what we're doing here. We're looking at a strategy that is a barbell portfolio. On the left-hand side of the bar, we've got one large, low-cost core holding being property. And on the right-hand side of the bar currently, because we're now starting to talk about super, we've got 220k worth of funds, which say that's 150 kg weight, and it's invested in a number of different assets in a couple of different funds currently. But we know that that strategy alone is not going to get you to where you need to be. So what can you do? Well, why don't we look at the structure we've looked at in your part 1.1 world and go, well, can we do that in the part 1.1a world as well? And why would we? And is it appropriate? Does the person have the right financial resources, so income and balance? Do they have the right drivers? So why are they doing it? Why would they even consider that? Are they doing it just to buy property? Well, if that's the case, no. They need to have some real drivers that make sense, that they want to take control of their super and be able to identify and put in place a strategy that they're more comfortable with, they think better suits and better provides for their future. What are their behaviours? So are they good at looking after their documentation, and are they completely across their financial position, and are they going to be able to manage, not that it's something that's very important and done right, it's managed in a really not easy, because it depends on person's view whether it's easy or not, but it's really manageable and not significant in terms of time that it takes. But you know what happens though, is the day that someone takes control of their super is the day they actually get an interest in it. And so their behaviors change again, where they actually look at it and go in and say, what is it doing? How's it performing? And I've seen that so many times. So that's what happens with our customers and clients that become our members. They take control, take an interest, and really start to work it. So if those factors combined make it appropriate, then we'll look at it. And in the Part 1.1a world, we're going to move to that now, but just to clean up on Part 1.1, we've looked at how can we integrate a structure that allows you to help you reduce your debt more quickly, save tax, and put in place an asset that will grow for you and assist you to build your wealth for the future, to assist with dealing with that retirement shortfall. And we've done that. And then the benefits from that are, it's going to help you pay off your debt more quickly, so it's going to reduce your interest costs, pay off your home loan accelerated rate, it's going to save you tax, and it's going to be an asset that grows into the future, delivering you growth and increase net wealth from day one, because we're paying that debt down. We're using your cash flow to pay that debt down. It's a first step. We want to continue to do more of that and grow your portfolio by replication of that structure where appropriate, or focusing on debt reduction and then revisiting it at certain times in the future. And if you've got a capacity that only allows you to do a certain amount in Part 1.1 world, then we work within those constraints. We get the maximum value, and we really then continue to look at overall, how can we help you get to where you need to be? And that's where we really start to look at the Part 1.1a world. Now, so far I've talked about credit, which is our Australian credit license and credit assistance. Talked about cash flow in relation to that credit facility, those credit facilities. And in relation to property, well, that's a licensed real estate asset. So you need to deal with a licensed real estate agent. And we'll look at those property fundamentals and criteria separately from this discussion. And that's where we integrate one of our licensed real estate agents as part of that. And I'm certainly a licensed in that space, but again, keeping everything very clear. This is a business case. We'll get to the solution, the product, in the next radio show. Now, moving over to your super world, well, that's an asset that's superannuation is a financial product. So you need to be a licensed advisor in relation to licensed financial advice, and we've got those licenses, and we've got the ability to dive deep into what that asset is and how that works for you, because at the moment we're looking at what do you want to do. You want to put in place a strategy and structure that allows you to deal with those issues in your situation and allows you to grow your asset pool for your retirement. You've identified that currently where your money is invested, you don't know where it actually is invested, or what it's actually doing for you. Well, how do you fix that? Taking control. And to take control, we go, well, let's look at and research what your super is currently doing, because we're now in the Part 1.1a world. We've stepped over that line into the super world. So in the super world, we can see your super. You've got two super funds, and it was about 180 and 40,000, giving us a total household super position of $220,000. Now that $220,000 is invested in the usual suspects. We've got a mixture of Australian shares, international shares, fixed interest, listed property, cash, all the things that balanced funds are typically invested in. And we go, okay, well, $220,000 is only going to do so much. It's going to work its backside off to get there. And when it gets there, it's going to leave you short. What can you do about fixing that? And from a perspective of a property-focused investor, might be, well, can I take control of my super? Why would you want to? We'd have that discussion, but there's a lot of reasons around that as to why. And one of those main reasons is, at the moment, you're paying 9.5% of your hard-earned money, growing to 12%. So given it's your biggest financial asset, shouldn't you know exactly what it's doing today? And shouldn't you have control or more control and have the access to experts and advisors that can help you along the way? Well, absolutely. So what we've got now is we've got a $220,000 balance, 180 and 40, and there's a few pathways there. Now, guys, I've spoken with some of the, I've spoken and presented in front of thousands of people on this kind of topic. And one of those people was with Mark Boris as a keynote speaker at a large conference a number of years ago at the Gold Coast Convention Centre, talking to some thousands and thousands of people on this exact topic. And what I'd call it is the smart way to invest in property using super. And for that, we commissioned a report from one of the best and most recognized research houses, which was to look at what is the impact of layering property into a super fund, a typical balanced super fund. So if you took a typical balanced super fund and layered the best performing asset for the last 20 years property into that, what does it look like? The key findings are it both increases performance and reduces volatility. Now, I love the liquidity of shares and the liquidity that super in its current form provides, and you need that. And it's critical to someone's plan. So this is not about property versus shares. This is about having what you need, having both, having your cake and eating it too. How? Using a barbell portfolio. On the left-hand side, having a large, low-cost core holding, being one direct residential property at the moment, and going, well, wait, we've got one, we need more. In our personal world, our part 1.1 world, we've probably done enough, or we might be able to do two in our personal world as part of the business case to start with, depending on your situation, of course, and whether it's prudent and all those considerations, and doing it one step at a time or at the right time, just like now. So doing it now because it's what your business case needs. Because it's not about acquiring a property asset. This is about a business case, a strategy. And to fix that strategy, you need to plug in assets. We've identified that one asset to start with in the personal world is the right step. But we know we need more. And we know we've got a shortfall currently, and we know in our super world, well, it's only going to do so much, it's still going to leave us short. So can we do something different? Can we take more control? We've ticked off all the gate openers in terms of appropriateness for that person. Going, well, you know, what are the pathways? And we'll talk about those pathways, and I just want to finish off that adding and layering property to a typical balanced super fund, where we were at just a little while ago, was it increases performance, reduces volatility. And the optimum number there was a mix of about 50% property, 50% shares or usual suspects of liquid assets. Now, we often can't start at that level of 50%, but the big point is, so in a super fund, having 50% in direct property and 50% in the usual suspects, we often can't start at that 50-50 range because the property asset is a larger, low-cost, once-off acquisition. But we are going to get there. Our aim is to get to that mix in your overall portfolio of 50-50. 50% on the left and 50% on the right. But to start with, even if we were to go to 80 or even 90% in favor of, say, direct property, what happens is, and the effect in that report that we've seen and what it's shown in its very clear findings is that it will the performance will still stay above a typical balanced fund, but the volatility starts to creep back up. So what that summary is by layering property into a balanced super fund, it will increase performance and reduce volatility. That's at a 50-50 level. If we take it to, say, 70, 80, 90% in favor of property to start with, your performance is still higher. The volatility starts to turn back a bit to be a bit more volatile, but still less, the critical comment, less than what a balanced super fund by itself would be in terms of volatility. Why? Because back to that conversation right at the start, that banks will lend you up to 50% of shares, up to 90 or 95% against property, showing that putting a smoother ride asset in with shares is going to bring that volatility down a bit. So with that, we go, well, how do we do that? Well, we take control of our super. There's two options. What you could do is we could, pathway one, is we could continue in an industry/retail super fund and have that money being 180K and 40K continuing to work for you, knowing that it's got to work really hard, and even if it works really hard and with some extra contributions trying to save for retirement, it's going to get you to a point, but it's going to leave you with a shortfall and run the risk of not having anywhere near enough, meaning you have to work for longer. So or work for longer, or live for less. Like, that's the reality. You don't have enough to live, enough money to live when you retire. Well, what do you do about that? How do you deal with that? Well, that becomes a consequence, and there's some disadvantages, and from there you've got to make decisions that you may not have to make if you put a plan in place to fix it now, and a simple plan in that. So in your part 1.1a world, your super world, we go, well, that's pathway one. And sometimes we need to go down pathway one because it's the most appropriate. And there's nothing wrong with that if that's the most appropriate for a client situation. And we work it really well, and we work it hard. And our Elk Invest portfolio has performed exceptionally well and continues to in that space. That, for example, that even with the ups and downs and some of the losses that really occurred during the first part of the COVID crisis, meant that our clients didn't have any loss of capital, that the balances went back to what they were about a year and a half ago, and all it did was wipe out the gains. So they were still in good stead. And that's gone from there and continued forward. So the performance in our Elk Invest portfolio, which we'll talk about again in a different radio show, has been great, superb. It's been titanium gold standard. And that'll make more sense to you once we have that discussion in that radio show. And let's look at pathway two then. Well, pathway two is what they call a self-managed super fund. It's where you take control and you'd roll that money, that 180 and 40, 220,000, and 220 plus, or wherever it is around that mark. And depending on client situation, they might have larger income and have a plan to grow their balance more quickly because of that contribution. So we look at it on a case-by-case basis. So we've got 220K to start with. We roll that money into what's called a self-managed super fund. That self-managed super fund has then been able to allow you to pool your household assets and put it to work. And one of the things that self-managed super funds can do that the industry or retail super funds can't, or just a standard super fund can't, is borrow money. Now, in the part 1.1 world, we identified that it was smart, it was prudent and creditworthy to grow your asset pool by integrating an asset allows you to borrow against with rates that are fixed at some 2.5% or low threes, still very, very good, against rent yield at 5%. And that was borrowing 100% of the purchase price plus costs. But imagine now, look at $220,000 in cash that's been rolled over from your super funds, so your respective super funds, super fund that might be Australian Super and super fund other might be Q Super or Sun Super, and we keep those funds in place because there's often some personal risk protection insurances in there, and we want to keep you protected, and we'll do a review of your personal risk protection strategy currently in place and your needs and provide advice and assistance in that. But that's a byproduct of our service. It's about making sure you're protected. We have a fiduciary obligation to do that. It's something you need to do anyway when considering a self-managed fund. What we are talking about at the moment is a strategy. So we've got a strategy where we've got your super, and we've identified that what if we roll it out of where it is into a self-managed super fund, and we put an investment strategy in place that allows you to build the barbell portfolio we talked about, to acquire a large low-cost core holding and put that on the left-hand side of your bar, and that would be held in your super world. And then on the right-hand side, use the money that's left over to invest and continue to invest in those usual suspects of assets, such as Australian shares, international shares, etc., that have worked so well. And we're now starting to get that barbell portfolio looking like what it should be. And as I was saying, in your part 1.1 world, your personal world, we identified that it would work well even borrowing 100%. Well, imagine you had 220K in cash. We're not going to use anywhere near all of that, by the way, but we use, say, an amount to equivalent of maybe 20 or 30% of the proposed property value as a cash deposit. Imagine if you rocked up to an auction today and you had an asset worth, say, 500K, because we already know the range and price point of the asset should sit around that mark to do the fundamentals and criteria, or to meet the fundamentals and criteria it needs to. So we go, well, let's put that 30% deposit down in cash and simply borrow the rest, 70%. Well, do you think the rent would do all the heavy lifting and look after the payments for you, the interest cost? Well, the answer to that is yes. And especially at the moment, when we look at the rates where they are. And if that's, say, a 500K asset, and we've got a 20% deposit, that's 100 grand. And then we've got costs. Now, the big thing about SMSF property, self-managed super fund, SMSF property, it's got to meet criteria in addition to our fundamentals and criteria. And we obviously have an answer, if you like, of that extra criteria. And one of those things is it's got to be built, it's got to be established property. And so your stamp duty on an established property as compared to in the event in your Part 1.1 world, and if we look at the fundamental criteria, just a snapshot now, in your Part 1.1 world, what if it was land plus construction built? One of the benefits there is you only pay stamp duty on the land component. So instead of paying, say, 12 to 15,000, you might pay only 5,000, saving you 10 grand in entry costs. That's one of the smart things and one of the benefits that we look at and test, and we can touch on that in our next show. But in your self-managed super fund, what it's got to be built. So you're paying about 15, 20 grand in stamp duty. Talking about 120, let's call it 135 all up in costs, the deposit. From that 220, so you've still got 90K left over in cash. So let's say $90,000 in cash left over. We could increase the deposit slightly, have less borrowings. But the thing is, once you'd put your deposit into a SMSF property and it's locked in, that cash, that equity is locked in. You can't redraw. If the property value goes up, you can't redraw on that equity or the deposit made to use it to go and buy another asset in the future. It's locked in until you sell that asset. So we're going to get the deposit levels right and the mix of cash left over right, because we want to reduce interest costs and better smash that debt on the property you've acquired, that 70% loan. So if you've got, or 70 or 80% in this instance, 80%, if you've got a $400,000 loan against a $500,000 property, and with that, you've got about 90K left over on the other side, all of a sudden, your super fund's gone from 220K in value to 500 plus 90, $590,000 of investable assets. Now, there's a couple of points I'd like to make on that. That 400K loan, we want to pay that back as quickly as possible, but not at the expense of being able to continue to grow the right-hand side. So we get the mix. We'll start with that 400K loan being principal and interest, paying it down. We might step that up a bit to pay it down at a quicker rate, whilst always having the ability to continue to grow the 90K from the cash flow for the super fund. Now, when was the last time your super fund caused you any cash flow issues? Never. And we don't want to see that again. We don't want to see that occur either. We don't want to see that occur at all. And how do we do that? Well, it's really creditworthy, really robust. We're only going to borrow between 70 to 80% of the value of an SMSF property. So the borrowing amounts at, say, $400,000 or less. And we then have a situation where what is the cash flow, the income to your super fund? Well, there's your contributions. And if you're earning, say, $170,000 in cash flow from your wages, and your super contributions are 9.5%, that's about 16 grand a year. 16 grand a year going into that super fund, plus the rent of some $25,000, $26,000 a year. So all of a sudden, we're at about $40,000 plus in cash flow into your super fund. So the 40 grand plus goes in. That's from your super contribution, so your employer's super contribution plus the rent that goes into your super fund. That's self-managed super fund. There's a bank account. That money gets rolled in. So start with the self-managed super fund gets established, and what we call Mr. and Mrs. Example Superannuation Fund. And there's a bank account. That money gets rolled into that bank account. That bank account might be with Macquarie as an example. And then you take that and you then go, what can I use that money for? What's my investment strategy built for? It allows you now to have more control, to consider other assets, to take more control and do more things with it. Because you need to, because you've got a shortfall for your retirement. So you go, well, what if we use a portion of that 220, say 135 odd, 130 odd as a deposit, and we therefore put in place a property worth 500K, adding another weight. Now our second 200 kg weights, left-hand side, the overall barbell portfolio we're building. Meaning we've now got two large low-cost core holdings, one in our personal world and one in our super world. And in both situations, they've got some borrowing, but really robust and creditworthy, and we're paying those loans down. In your super world, we want to pay it down even quicker because it's got 40 grand of cash flow from your super contributions and the rent. And what comes out of that? The interest cost, your holding costs to keep the super fund open and active and compliant, accounting costs, audit costs, any insurances, and property holding costs. What's left over, though, is you can pay off that debt much more quickly than a 20, 25 or 30-year loan term. So it means you can actually have a debt-free property by the time you retire in the super fund. Now, that's the most simple plan. As I said, what we want to do is get more of a balance, a blend, where when we start to really tweak it and refine it and manage it, we go, well, let's get the best out of this baby. And so what we do is we go, let's make principal and interest repayments on the loan against our super fund property. And there's a whole lot of detail around how that gets structured, and so the self-managed super fund and how the property is owned. So guys, the most important thing is this is general information, general advice. It's not personal financial advice. If you want to talk about this, want to go through it, give us a call. We'll go through it and go through it in detail. So on this, we'll have another radio show that talks about, well, how do you go about structuring yourself in super fund? How does it all work? The details and all those other important pieces of information that you need to know. And we'll have a special session on that. But keeping it simple, you've got that asset owned by your super fund worth 500k, you've got a debt of 400k. We're going to smash it as quickly as possible. But we're not going to do it at the expense of growing the right-hand side of the portfolio. Because at the moment, we've got about 90k of investable funds we want to put to work in the usual suspects: Australian shares, international shares, fixed interest, listed property, cash. So we get a mix where we go, okay, let's slice off or have the right amount of your contribution going towards the right-hand side of the portfolio, and the right amount above it going towards the left-hand side of the portfolio to pay down that debt, to get to an end position of 50-50. So guys, look, that's our strategy, the barbell portfolio, the strategy, structure, and solution, how we get there in overall strategy, and then each part of your each one of your financial worlds. We've gone through that. So I want to thank you for listening. Thank you for the time spent and the detail you've taken on. We're going to start to break this down into specialized series now of radio show. We talk about each part. But as a result, guys, what have you achieved through this? Mr. and Mrs. Example have come out a whole lot better. They've taken their situation from being a homeowner with a standard bank loan to now having a structure, strategy, and solution, or strategy, structure, and solution in place that gives them in their personal financial world an investment vehicle, being property. Then from there, on top of that, they've got the ability to pay down their debt, their home loan more quickly, tax savings, and that investment vehicle in their personal world is going to grow. So the benefits are absolutely there. And it's a long-term asset. And so it needs to be treated like a long-term asset. So it's not going to give you returns and growth from day one. You need to have a long-term view and let it do its thing over time. And RP Data just on this had what's called a pain and gain report. And what that report showed is that for people that own property, it's about the 10 to 12 year plus mark where they actually start to see the gain. Anywhere up to that, in some instances, it could be a bit of pain. Well, what I mean by that is there's been no growth or minimal. But it's a long-term asset that over that long-term period sets it as the best performing asset in Australia for the last 10 years plus, last 20 years. So the benefits are there. And then we look at our super world. We're going to take control, put in place an asset that allows you to do the big thing. I don't want to miss this. Put in place an asset that allows you to have more money invested. Now let me ask you this. If you had 220k invested today, or you had 500 plus 90, 590k invested today, what do you think it'd be worth more in 20 years' time? Well, it's obvious, and that's even if there's borrowings in place. By managing those cash flows and paying down that debt, the big thing is you've got more money invested, accessing more open market forces. And you need to continue to grow it because, what happens is as you get close to retirement, you can't go with an all-out growth strategy. You've got to peel it back a bit. And that means that 220K, then say 800, 900 can't be put to work its ass off as much because it runs the risk of the ups and downs in that volatility of that asset. So can we have a strategy in place that allows you the smoother ride, more money invested to get you there in a better way? So the benefits are more money for your retirement, allowing you to have the future-proofing strategy you need, the money you need when you need it. And I'd love to have the opportunity to talk with you about how that works for you and what that actually means for you. So thank you very much for listening, and wish you well. Cheers.